So last night, like I said, you had your AUD, you had your New Zealand news. All right, AUD pulling down, which has pushed your Euro AUD up. Okay, and your New Zealand up drastically. Pound AUD, okay, with rejection now. That's the only one that differs a bit. And then your pound New Zealand also seeing a fade out of those long entries and a weakening of market strength. Now, like I said, even on your 1 hour, for example, you're getting the same thing like I was saying with key indexes, right? At some point, after big rushes up, you get big rushes down because everyone kills their entries. Now, the difference with things like your pound New Zealand, euro New Zealand, etc., is that you are at key technical zones within that sharp push. Now, again, it comes down to price action. If you look at your higher time frames, it's the easiest way to see key price action because you get rid of all of those 1,000 candles on your 15-minute chart, something like that. So, yeah, if you look on your weekly, for example, you've got this very near-term downtrend. You started in the summer, okay, so it's mid to near term, and you're starting this trajectory of pulling down. First leg starts with that push there, and then that lower low there, and you've got lower highs consecutively in the same period. All right. Now, because of my bias again on pound New Zealand, I would be looking for rejection just like you had it there. So at this point, I'm short. Okay, I reshorted this morning. Now you can see that your key moving averages here, which are guiding you for the long-term market price and which are always returned to, exist under these lows. So it should give you an indication of where the trend may be taking you. Okay, because these levels are where you have that key price action to the long side. Okay, it's all along here. You can see it all below. There's just piles and piles and piles of rejection all the way. It's really strong for rejection. Not only that, it coincides with your key 200 moving average. So you've got so much confluence here, basically making like a brick wall barrier. The brick wall can be smashed, okay? But if you were looking for re-entry within this near to mid-term downtrend, you could take it from here, for example. It would probably be something down there, or at least your key moving average 100 would curl up slightly, and it would be something like that, and it would coincide more or less like this. Remember, your lines need to be parallel, if they can be, at least. Okay, so it would be something like that, and then ultimately that would cause your further low down here. So if you don't get to that place I drew first, where you've got really strong price action, you may end up there first, because even at that point, below this low, okay, and remember, every level has to be broken in the markets repeatedly until you get further and further down, you've still got key price action here, which could still cause rejection easily, and it's a strong area for where traders and investors alike would re-enter the market. Now, you're only going to get there once you've got a continuation of this long-term weakened sentiment, okay, for the pound, and the long-term strength for the New Zealand dollar, or at least the mid to long-term strength of the New Zealand dollar, okay? So essentially what that means is the pound is weakening, okay, and you're basing the two off the comments, actions of the central bank and the economy underneath it, because the central banks in either jurisdiction control the flow of money, and the flow of money controls the price. So it trickles down as one. So you would find that if your New Zealand dollar is out competing in terms of attracting foreign investors to hold currency for a better return, essentially, that is how the economics of currency markets work, then you would see that continuation. But even so, without knowing that market sentiment exactly, okay, and remember today it has changed, and you'd have to wait for Bank of England now, you've still got reliability in that key price action or technical bias that you formed, because you know if you're taking that technical bias and you're taking those entries at key price action levels, you'll statistically get an edge over the market, statistically with the correct risk adjustments, okay? Because price action levels probability and everything like that needs to be correlated directly with risk. In any market where it relies, and I don't mean trading specifically, but anywhere that relies on probability to get a consistent assumption over time, has to be tied with risk to make the picture work. If you're not tying it with risk, then the picture doesn't work. The picture gets faded, the picture is blurry, and ultimately you'll find that you can't exist in the market with those extreme market swings. They go on too long for what your equity and your risk adjustments, your plans, your sizes, everything like that, your data analysis, all the number side doesn't work unless you've got that tied together. Because obviously, if something is more likely to occur, you could change your risk accordingly. If it's less likely, like now based with the market sentiment, you could change that size, or you could change it based on the price action level, how strong the price action level was it strong or not. Again, that needs to be tied to risk because the probability of that area is weakened, so you may include a lower risk on that. So pound New Zealand and, for example, euro New Zealand for myself are still short, and you can see again, like I was saying before on this stream, at the bottom side, you've got this weakening level. Okay, it can only be hit so many times before it loses its strength to the downside. And again, if you want to call it a pattern, you can. But simply all that's happening here is you're seeing renewed weakness in the market, renewed New Zealand's dollar strength over this time period, which is pulling you down and down and down and down and down. And as you attack those lows more, okay, the defenses start to weaken, if you like. If that helps you understand as an analogy, and you go to the next key price action level, which again, funnily enough, just happens to be in line with your higher MAs. Why is it in line with your higher MAs? Well, it's because your higher MAs track the long-term investor levels that will eventually be hit at some point. At some point, when you're talking about major economies, nothing manipulated like the Turkish lira, for example, you will always come back to those MAs. They are the guide for your key price action and your key long-term entries. Again, risk must be scaled. So pound New Zealand, euro New Zealand, pound AUD, short as well, because they're coming very hand in hand, those antipodean currencies. Again, they're all in their short downtrend fashion, so I'm